Hey, it's Ryan Reynolds here from Mint Mobile. Now, I was looking for fun ways to tell you that Mint's offer of unlimited premium wireless for $15 a month is back. So I thought it would be fun if we made $15 bills. But it turns out that's very illegal. So there goes my big idea for the commercial. Give it a try at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan, equivalent to $15 per month required. New customer offer for first 3 months only. Speed slow after 35 gigabytes if network's busy. Taxes and fees extra. See mintmobile.com.
Reality radio for a really great future. We're talking real money.
We interrupt your regularly scheduled Real Money Talking program to bring you real money news. Yes, once again, ladies and gentlemen, the stock market has done exactly what it's supposed to do, go up over time and occasionally hit new highs. Yeah. Big surprise. You know, it was the headlines. It was like the headline yesterday. It was like, stock market hits new highs. Like, that's a big deal. Is it really a big deal? I know you call and talk with us a lot about it and make a big deal out of it. Well, with the stock market at all-time highs, shouldn't I wait to invest? Well, the stock market does all-time highs. And it did them again. Hi, everybody. I'm Don McDonald. Welcome to Talking Real Money, the radio show, and a podcast eventually. Tom is still in Europe. Well, at least I thought he was in Europe. He had a picture of himself at some beach called Utah, which I realized then wasn't in Utah. It's actually in Europe. He's doing his Normandy tour, and he'll be back with us in about a week, talking real money again. So today it's me and you. Of course, you're important. And you, yes, you can call me. Yes, me, at 855-935-TALK, 855-935-8255. What do we talk about? What's the name of the show? Talking Real Money. So if you have a money question, concern, problem, thing, second opinion you're looking for, just call. It doesn't hurt. It's easy. It's free. And we can actually have a conversation as opposed to you sending the questions in at talkingrealmoney.com like many of you do. So 855-935-TALK, 855-935-8255. Yesterday, the S&P 500 managed to sneak up to, what was the number? I've got it right here. The S&P 5, I was just looking at the individual stocks that went up. It closed at 6173 on June 27th, which was above its previous high, all-time high, from February 19th of $6,100, or 6,100 points, 6,144. Now, that's pretty impressive when you look at what happened between February 19th and June 27th. In April, the S&P 500 was just under 5,000. It's gone up about 24% since April, which makes it the fastest bounce from that big a drop ever. And if you think that it was led by the usual suspects, you're thinking, well, of course, it was Apple and Microsoft and NVIDIA and Meta and Alphabet and all those guys. Nope, they weren't. They were basically uninvolved. I mean, they were involved, but they weren't the big ones. The biggest one the biggest mover since February in the S&P 500 was a stock I didn't even know was in the S&P 500. That's how much attention I pay. Dollar General. Makes sense. It's a big company. But Dollar General gained about 15% over the course of a few months. It was the big mover. And the other big movers, like the ones that went up a lot last week, are kind of unique. I mean, one of them was Coinbase, running up on the hype over Bitcoin. Another one is I just have the list. I don't know what these companies are. Jabil or Jabal Circuit. Don't know who they are. Kroger, I buy groceries from them, but they don't have a store in Florida, so they deliver. SD Lauder, I never have spent any money with SD Lauder, and I don't know why they were up when their CEO or former CEO was gone. Caesars Entertainment, gambling's always big. Advanced Micro Devices, well, there's a computer company. Oh, and Dell, and Super Microcomputer. And then Live Nation and Takeda? I'm not sure. I don't know who's what. All I know is that it wasn't led by the usual suspects, which tells you why it's so important for you to be well diversified. It also tells you why the whole thing, you need to be invested all the time. Because despite the fact that the stock market took a big hit and everyone was scared, it went to a new high again. 855-935-TALK.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
It is officially moving season, a time filled with hours of packing, unpacking, and so much bubble wrap. But the first thing you should do when moving into that new home is to make sure the Wi-Fi is booming with our friends at Xfinity. It's super quick and easy to set up. Then, boom, you'll have your new home hooked up with the ultimate Wi-Fi experience faster than the time it takes to parallel park that moving truck. Then you'll be back online with the most reliable Wi-Fi with the best in-class equipment from Xfinity. So you can just kick back, relax, and stream your favorite movies and TV shows while someone else deals with all those boxes. Because with Xfinity, the only thing you have to worry about is remembering where you packed the remote control. Make the right and easy move with Xfinity. Learn more at xfinity.com/move. That's xfinity.com/move. Restrictions apply. Not available in all areas. Most reliable Wi-Fi claim based on Open Signal Awards USA. Fixed Broadband Experience Report, August 2024. Remember that website again is xfinity.com/move.
Tom Turner and the Northwest Auto Show talked to another happy customer of Mathewson's Automotive in Renton.
Bill and Tukwillow.
Big shout out. Thank you to Josh and Jake at Matheson's.
Yeah, they're good guys, huh?
Oh, they're outstanding.
Mathewson's Automotive, proud to be a AAA top shop, celebrating 90 years of service excellence. Call 425-226-2965 and keep your car running with their team's combined 240 years of knowledge. Mathewson'sAutomotive.com.
Traffic on the fours, sponsored by Northwest Crawl Space Services.
I-5 southbound in the northbound Everett to Seattle, a 25-minute crash-free ride. The reverse trip heavy and slow, I-5 northbound at the West Seattle Bridge, a crash in your right lane, a crash I-5 northbound before Mercer, and plus a disabled semi on I-5 northbound at Northeast 65th Street. As adding to your travel times and making I-5 northbound Seattle to Linwood a 45-minute ride. On the east side, 405 southbound Bellevue to Renton, 15 minutes. Valley Freeway looks good between Renton and south to Auburn, 10 minutes. 405 northbound is where you are heavy. You're closed between Northeast 70th and 124th Street with construction until Monday. You're slow and go from before 8th Street on the way there. And take a look at the traffic in the South Sound. I-5 southbound slow after 512 in Lakewood to just after JBLM with the Freedom Fest going on. In the Northwest News Radio Traffic Center, I'm Karen Trombley.
We're live without music. Hi, everybody. Welcome back to Talking Real Money. I'm Don McDonald. I'll fix that for the podcast. 855-935-TALK is our phone number. If you have some money questions, well, I'd love to talk with you. So give me a call. It's easy. And I'm such an idiot. I really am. I said, J-Bill. And then I went, during the break, my brain kicked in and I went, oh, Jabil, the contract manufacturing company. I know them because I've done lots of corporate video work. I've done voiceover work for Jabil. I should have totally known who they are. Not the, senior moments. Hey there. Thanks for being around. As mentioned, the stock market, as represented by the big blue chip U.S. stocks, the S&P 500, had a decent run up over the past couple of months, and that ended with a new all-time high. So, when we get a new all-time high, you know what that means. It's over. It's over. It's the all-time high. Isn't that what all-time high means? It's the high for all time? No, that's not what all-time high means. That's why I made fun of it at the beginning of the show. All-time just means all-time to that point. And all-time highs are to be expected. As a matter of fact, there'll be something horribly wrong with the global economy if we stop having all-time highs on the various stock exchanges and stock indexes. We must have new all-time highs. It's not a zero-sum game over the long haul. Day-to-day, stocks are a zero-sum game. Buyers, sellers, kind of offset each other, winners, losers. The reason stocks have made money for centuries is because the economies that are represented by those companies that are publicly traded have grown more productive and larger. Is there any doubt in your mind? If there is, then you're apparently a flat earther. Is there any doubt in your mind that the economy of 2025 is larger than the economy of 1975? Any? No, it's dramatically larger. And that's represented in the prices of stocks in aggregate, global stocks. Now, the global markets didn't hit an all-time high last week. They did hit a one-year high. The MSCI All-Country World Index hit a 52-week high of like 916, somewhere around there. And that is up just 5% from its bottom of 869. What does that tell you? That the global index has not gone up as much as the S&P 500, but also it hadn't gone down as much as the S&P 500. What is that telling you? That is illustrating the value of global diversification. We don't suggest you globally diversify your portfolio because we think you're going to make more money, because you wouldn't have. That's not why we suggest global diversification. This illustrates it. The reason we suggest it is reduced volatility. It hasn't, we don't know what it's going to do, but it hasn't gone up as much, nor has it fallen as much. They don't move in lockstep, but they don't move perfectly out of step either. They don't totally non-correlate. But they don't move precisely together. Plus, you have, instead of 3,000 or 4,000 stocks like we have in the U.S., you have 12 or 13,000. So you have a lot more, I guess it's ballast in your portfolio. No, it's not as much fun. It's not nearly as exciting. But, there was an article, I think, was it in the Wall Street? Let me look it up. Hold on. See if I can find it. There was an article in the Wall Street Journal, I believe. No, I'm sorry. See, I read so many of these publications. There was an article in Business Insider about a guy this article says he has a portfolio, a $2 million portfolio. This is the Business Insider article. Consider the source. He has a $2 million portfolio. Man, I hate saying that word, because his portfolio is one stock. So over the past 5 years, when did he start buying it? He started buying it in 2022, 3 years. Over the past 3 years, He has been steadily investing in one company, and he keeps, adding a little money along the way, and he's grown that to $2 million. The stock is Palantir, and it has been a huge grower, but it's been a huge grower past tense. What's it going to do in the future? This guy is absolutely exposed to massive volatility. Now, he's trying to protect against it by writing covered call options, but that in a massive downturn, he could still take a horrible beating with the wide spread he has between his strike prices on his options. So he's not really protected. You, on the other hand, if you have the entire global market, the MSCI All Country World Index, which is represented by a fund like VT at Vanguard, you don't have to worry about Palantir getting walloped. Because while you own it and you get to participate in it, you don't have a lot of it. And if it goes belly up, you're not in trouble. And Palantir is one of those companies that, it's very reliant on the government for its income. It's in an area that is very competitive. And as we see with tech companies, they can fall from grace very quickly. We saw it happen with Tesla. We've seen it happen recently with one that seemed impervious to declines, and that was Apple. So any company, anywhere, anytime can get in deep trouble, and no investor should even have all of their money in the S&P 500, which is 500 stocks, much less in one company. This guy, he went on to say, I'm now planning my retirement, which is approaching much sooner than I ever expected. Gee whiz. Yeah, you did well, but are you smart? Or were you just lucky? I'm pretty confident he thinks he's smart. Oh, and by the way, do you know where he keeps his ledger of his purchases and his returns on the stock? He writes them with a Sharpie on his garage wall. This, ladies and gentlemen, is a sophisticated investor. So you've got to be diversified. You've got to live with what the markets do. But the way you can live with what the markets do is because you diversify. It makes it feel better. And by the way, just having the total world market makes the stock market less volatile. But if you throw into that fixed income in one shape or form, either through laddered CDs or through owning a bond fund or whatever it might be, you further reduce the overall volatility of the portfolio as long as you're very, very, very disciplined about looking at the portfolio as one entity. Don't ever look at it as parts and pieces. Look at it as one big thing. And if you have a 60% total world and 40% bond portfolio, you're not going to see those big swings in either direction. You're not going to get rich, but you're not going to get poor. Not unless the world falls apart, and then all bets are off. 855-935-TALK. Give me a call.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
And please bear in mind that you have lots of time to call and lots of things we can talk about. Just give me a holler at 855-935-TALK, 855-935-8255. I'm here. Tom's often here every Saturday between noon and 2 Pacific as we air live on Northwest News Radio in Seattle. And then I think that's 3 to 5 for everybody else in the country who can listen to it streaming and also listen to our podcast. Let's go to Covington. Don, welcome to Talking Real Money.
Hello.
Hey, Don, what's up?
Well, I must say I managed to catch your show once in a while when I'm in the car, and I kind of liked your guys' philosophy on investing. And I was curious. Some time ago, when the market was really down, my wife and I are looking at this and we're thinking, geez, it would have been nice to have spent that money instead of watching it all drop. Well, we stayed in. It's come back. I got my question is to you. We have been drawing, when the market's up, we take like 10,000 off every once in a while. So I'm not quite sure how much information you need to have here. But
it sounds like you're drawing money off to fund your liquidity pool. Is that what you're doing?
Yeah.
To fund your expenses along the way, which I think is what you're doing is a lot like what we espouse, and that is taking some of the money from your winners and putting it aside for your spending money in retirement, because it's just a natural offshoot of rebalancing.
Okay, well, and that's where we're at. I've been retired 15 years.
Yes, sir.
And we use this money. Most of this money that I'm putting is in Roth IRAs, and we use that money to buy big items, like we buy a car, or we want to help out the kids with something. That's where that money comes from. And what we like is there's no taxes. With what we take out, we get.
Yeah, because it's a Roth.
But yeah.
As long as you have a discipline, Don, as long as you have a disciplined approach, and it sounds like you kind of do, when your portfolio value increases, you just skim off a little of the money you've made and replenish the funny money pool, the big purchase pool, the take the kids on vacation pool. Is that right?
Yeah. Yeah. But I guess my question, or what I'm wondering is, how do you decide which of the funds to take the money to draw down?
Well, that's a different thing entirely. Do you have taxable accounts and non-Roth retirement accounts?
Yeah.
Then you're cutting off your nose to spite your tax face. You should leave the Roth alone. Okay. Even though it feels better to take money out that's tax-free, it's better to let it continue to grow tax-free and go ahead and bite the bullet, because you've got to take money out of the IRAs because you've got RMDs. Right. So you got to take it out of there. So you might as well take it from there. But our order of withdrawal is taxable accounts first, unless it's an RMD. IRAs, regular IRAs next, Roth last, because even though it feels nice not to pay taxes, it feels even better not to pay taxes on more money in the future.
Yeah.
I know it feels bad, but it's the right thing to do, because it's compounding upon itself at a much more rapid rate than your taxable account is.
So you're saying that we should, if we wanted to take out extra money, we should take it out of our regular IRAs.
Yep.
And pay the tax.
Well, actually, again, first, take it out of your non-IRA investment account. First. Then take it out as your RIA or your RMDs from your IRA. I got all my letters mixed up. But wait on the Roth for as long as possible. I know it's an emotional thing. Beware emotion.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
I feel like you really have two choices when it comes to talking about, learning about, dealing with money, particularly investments. And that is, one, you can be confused. You really can. You can be just baffled by the BS. Or you can be informed and enlightened and kind of get it straight. And that's what we do. While what we do may not be as exciting, it's a lot safer. 855-935-TALK. That is a phone number. You remember those. You dial that into your little device that's electronic and makes connections to people. And it's not texting it, but it still works. And we'll talk every Saturday. So give me a call, 855-935-TALK. We'll talk about money because the show's called Talking Real Money. I'm Don. Tom's away. And Dave in Gig Harbor is up next. Hi, Dave. Welcome to the show.
Hi, Don. Thanks for having me.
My
I
pleasure.
was listening to the podcast. Enjoy it. I was listening to the Q&A with Tom and Roxy that dropped yesterday, or appeared at the top of my list either way. And in the first few minutes of that podcast, Tom makes a reference to the ability to transfer money, unused funds out of a 529 to a Roth. And then he made a reference to $29,000 annual figure.
What?
And I'm not quite sure where he got to that, because wouldn't it be capped at the maximum be $7,000 or the amount of W-2 income?
Yeah. He just means over the life of it. And I thought it was like 30 something. Let me see if I can find the. I want to get the exact number because I haven't talked about it in a while. 529, transfer to Roth. It is 35. That's what I thought. I thought it was the $35,000 lifetime limit per beneficiary, but you can't do the $35,000 in 1 year. It has to be based on the annual limits of that person at their age, which is $7,000.
Okay.
So you can do it over a period of time, but you can't do it all at once.
Okay. Thank you.
You're very welcome. Now, I did not listen to all of the show, so I edited it, but I don't think I listened to all of it. But I'm just looking through the transcript to see. Yeah, I don't know. I don't see where. But it is just up to the max. $35,000 lifetime limit. This is really a nice feature of 529s, folks. This makes them really extraordinary. They used to be good. I mean, they're great because you can grow money tax-free for a child's education, college education, trade school education, all manner of education, even pre-secondary education. So you can pay for education, which was great, to get a tax benefit to pay for education. But then they added this Roth IRA deal, which I think may in some ways be better than the school part. Because if you can put $7,000 the first year you have $7,000 of income into a Roth IRA when you're in your like teens or early 20s, wow, what a retirement you're going to have. And really a big part of what we work for. We may not recognize it at the time, but a big part of what we work for and a large chunk of what we save and invest for is that thing that happens when we get older called retirement or something resembling retirement. I mean, it's not always just, kicking back and doing nothing or playing golf or, gardening. Oh, heaven forbid. Maybe that's why I'm not retiring. What the heck would I do? But the fact of the matter is that's what we save for, because for most of us, probably even for me, there will come a day when I'm going to need income from my investments to support us, support me or me and my wife and the dogs. So that's what we save for. And to be able to get it started really, really early with money that was given to you by your grandparents, wow. I mean, it just doesn't get a lot better than that from an investment standpoint. We have lines open, lots of time remaining, 855-935-TALK.
Tom and Don are talking real money.
Hi, Don McDonald here. So what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
Well, this weekend it's just Don, and I am Don, and Tom is in Europe, actually visiting or he was visiting, it's getting late in Europe, the beaches at Normandy. It's his D-Day pilgrimage. Because, and I get it. It's a moving place. His dad also fought in World War II. He was a B-17 pilot. So he'll be back with us in about a week. 855-935-TALK is our phone number. That's 855-935-8255. And as you are probably aware, if you've listened at all, you know we love the work of Jason Zweig over at the Wall Street Journal. And he covered another one of these ridiculous, scammy, smelly, just almost evil, semi-mainstream investment vehicles, an ETF. These are actually, and it's a number of ETFs that have been promising investors, get this, 50, 70, 100, even more than 200% yield on your portfolio. Now, what's a 200% yield? What does that mean? You put $10 in and you get a $20 dividend, right? That just sounds really good. And these funds have sucked in a lot of money, billions and billions of dollars, because people are falling for the pitch. I mean, they're promising 200% income on Tesla. But are they? Well, there is a ETF from a company called YieldMax. It's the Tesla YieldMax fund. It came out a year and a half ago at about $40 a share, promising huge returns. They're advertising right now a 62% yield. 62%. $40 a year and a half ago. What's it worth today? Less than $8. Wait. That doesn't sound like a 60% return. Oh, no, they didn't say return. They said yield. And how do they get that yield figure? Well, they just take whatever the last month's payout was and multiply it by 12. It's basically lying. The stock over that period, that year and a half, if you had just purchased Tesla, you would have seen your wealth grow by about 70%. The fund, its yield has actually been about 7% per year, and the total return, oh my gosh, look at the numbers. And these funds aren't just buying Tesla and then paying you a dividend. What they're doing is they're buying Tesla and then they're selling options on Tesla. However, it's even worse than that. They're buying Tesla through a leveraged ETF. In other words, they're borrowing money to buy more Tesla stock, and then they're selling options on that additional Tesla stock. That's betting times 3? This isn't investing at all. This doesn't even resemble investing. This is pure, unadulterated gambling. And you knew that this was going to happen with ETFs because they're easy to set up. There's very little bar to entry with ETFs, and there's a lot of money lurking out there that wants to make massive amounts, and people are dumb enough to buy these things. They're very, very, very dangerous. And there's just a stupidly simple rule you can follow. It's too simple. If it sounds too good to be true, just believe that it is. I mean, is it possible you're missing out on the one too good to be true offer that is actually true? Well, I'd rather miss out on the 1 in a million that was actually true than the 999,000 in a million, 999,999 that were indeed too good to be true. Just miss out on them. Just miss them. Just skip them completely. You'll be so much happier if you do. Give me a call, 855-935-TALK, 855-935-8255. That's our phone number. And there's another way, by the way, that people send in questions. They go to talkingrealmoney.com and they type them in or they speak them in. I answer those on Fridays. But the typed one the typed ones get answered all over the place, like this one. This was from Denver. In my rebalancing, I want to have a 70-30 portfolio, and I also have a reasonable amount of cash set aside. Is the cash thought of as entirely separate from the 70-30 portfolio, or should cash reserves be considered part of the 30% safer money or something else? I believe they should be considered part of your safe money, because they are safe money. And the point of the blend between stocks and bonds, whatever your appropriate blend is, be it 70-30, 60-40, 50-50, whatever that is, the point of that fixed income portfolio is dampening volatility. Well, very few things dampen volatility better than cash reserves. They're the best because they're not like bond funds. They don't fluctuate. They just stay at a dollar value. So they really do balance your portfolio out. So I believe they should be considered part of that safe money, that fixed income portion of your portfolio. The other reason is if you're a good investor and you're in retirement, you're in the phase where you're taking money out, you should be replenishing that anyway from your others as part of your rebalancing. So and if you feel you need to be more conservative, if you feel those cash reserves are sacrosanct, then I would still calculate them in, but I'd figure, okay, maybe I need a 60-40 portfolio. But in this case, I think that I would consider them part of the safer money because they're cash reserves, too. They're the money you may or may not need. That's another purpose for fixed income, is to have a safer portion of the portfolio so that you don't have to liquidate the more volatile portion, that 70% that's in equities, in a period when the stock market has been, over a period of time, performing badly. You don't want to sell an asset that's way down unless you have to. You want to have assets you can liquidate to meet whatever your spending needs are, so you don't have to do that. So it's sort of a dual purpose. Safe money has a dual purpose. It's to reduce volatility, but it's also to give you a source from which to draw money when the stock portion is not doing well. Thanks for that question. If you have questions, again, go to talkingrealmoney.com and type them in, speak them in, or every Saturday, give us a call at 855-935-TALK. That's 855-935-8255. So there are so many ways to get your questions answered, and it is our favorite part of what we do. So give me a call. I'll be here for a while, 855-935-TALK.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Again, the phone number, 855-935-TALK. Now, let's go to Connecticut. Mark, welcome to our program.
Hey, Don. How you doing?
I'm good. Thank you, sir. Glad you called. What can I do for you?
Yeah, Don. I'm thinking here.
Go ahead.
Why do I need a brokerage account? That's what I'm kicking around here. and I'll just give you my background real quick. I've got $125,000 in a brokerage account. Mm-hmm. I just went over $200,000 in a Roth IRA, and I've got $1.7 million in pre-tax 401k. And I'm 66, and I'm going to retire December 31st this year. Mm-hmm. And I don't know if I'm being cheap or what, but this brokerage account, I got 125 in there, and I've got a T-bill, a 52-week T-bill. I've got a money market, but I generate about $7,000-8,000 a year in ordinary income off of that. Mm-hmm. And I'm in the 22% tax bracket, 5% state tax. So I'm paying about $2,000 a year on this money.
Huh? Wait a minute. $2,000 a year to whom? Who's charging that much for a brokerage account?
No. In taxes.
Oh,
I'm paying
taxes.
22%.
You scared me for a minute. Okay.
Okay, so here's my plan when I get in retirement. This $1.7 million, I know I got to burn that down because I'm going to get hit with RMDs when I hit 73. I want to burn that down and move that, convert that money over into the Roth and pay for the taxes on those conversions from my brokerage account. But I'm sitting here thinking, why do I even need this? If I deplete this $125,000 in my brokerage account, paying the taxes on the Roth conversions, why do I even need this brokerage account? I mean, I can kind of use my Roth two parts. One part would be like liquid money to live off of, and then the other part would just be savings.
Yeah.
And it's all because
you don't necessarily need it. You're right. You don't necessarily need it. The only reason that I have a brokerage account is to keep my taxable assets. If you don't have any taxable assets, then you're going to keep your money in either the 401k or the Roth IRA. So you could have all of your more aggressive positions inside the Roth or the 401k, and you could just have a high-yield savings account somewhere to keep your cash.
Yeah, but I don't want to pay tax on it. So why not
but you can't
why not have that money in my Roth? So my Roth serves two purposes.
But wait, your Roth only has $200,000 in it.
Well, but if I move, so I have 1.7 in the pre-tax. Eventually, in probably 6-7 years, it's going to start.
Are you going to?
I'm probably going to have $700,000-800,000 in that Roth.
Are you going to be? Wait. Hold on, because I'm going to run out of time. You're going to be converting your regular IRAs or your 401ks into Roth?
Yeah, between age 66 and age 73.
Okay, so you're going to be paying taxes on that, right?
Right. And I'll pay it from the brokerage account.
Oh, okay.
But eventually I just figure I'll just deplete that brokerage account keep so my Roth will have two parts. Yeah. One part will be liquid money that I'll live off of, and then the other part would be any money that I didn't need, for emergency or to live off of.
I have no gripe about that, and thanks for your call.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's as fees and services. Apella Capital, LLC, DBA Apella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Apella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.